All right, it's March 10th. There's some big news in the financial world today with a classic run on the bank. In fact, as I'm recording this, it's being reported that the FDIC has moved in to take control of SVB Financial, which is basically a large bank that specializes in lending to tech companies. So I'm going to talk a little bit about how this has happened. Obviously, it's a developing story, but big picture, rising interest rates are a major contributing factor. That's what we're talking about. Stick around. Now, here's a screenshot of today's Wall Street Journal showing the share price or the stock price of SVB Financial Group. And you can see the shares have cratered this week as the bank literally faced a classic run. And what do I mean by that? Well, basically what I mean is depositors have showed up and started pulling money out of the bank, and the bank itself is having difficulty coming up with the cash to pay those depositors. Thus, the share price is taking a whack, and as I mentioned before, news reports as I'm recording this have suggested the FDIC is in the process of taking over the bank to protect depositors. Now, let me just touch on the fundamentals of how a bank works, because this is essential in understanding to comprehend bank runs generally. Remember, what banks do is they raise deposits to lend them out at a higher rate than they're paying on those deposits. So, for example, in this oversimplified example, let's say a bank has raised $900,000 worth of deposits. What it's going to do, it's going to lend those out. But, of course, per rules, banks have to keep at least so much of their dollars in safe assets like cash and even U.S. government bonds, things that can be sold quickly and are generally safe. Now again, as long as the bank can earn a higher rate of interest on its loan portfolio and investments than it pays depositors, well, this situation works out pretty good, or this model. But obviously, occasionally, you'll have a situation where a lot of the depositors want to pull their funds out at the same time. And the issue with that, of course, is if $900,000 of deposits are being drawn on, well, the bank doesn't have $900,000 worth of deposits in the vault, per se. The only way to raise those funds is to sell either, its liquid assets, in this example, it's U.S. Treasuries, or it actually has to start selling off its loan portfolio. Now, this bank, SVB Financial, which is in the headlines today, found itself in trouble for two reasons. Number one, depositors have been pulling cash out of traditional banks, partly because of guys like me, frankly, talking about how there's much better returns in the marketplace elsewhere. I mean, interest rates, short-term interest rates have gone up dramatically. Take a look. Here's the one-year U.S. government bond. And you can see over the last year or so, rates went from essentially zero to in excess of 5% right now. So, of course, anybody with a checking or savings account at one of those traditional brick and mortar banks, still probably earning, little to nothing. We've seen a trend where money is leaving for other securities. So that's putting increasing pressure on banks to come up with liquidity to pay depositors. Now, SVB didn't only get itself in trouble with depositors leaving to earn a higher rate of interest, they also found themselves in trouble because their investment portfolio or their assets are declining in value. And this has a lot to do with rising interest rates. Remember, when interest rates go up, bond prices go down, and in many cases, business values go down. So the issue at the most fundamental level, if you're a bank and all of a sudden you see your assets declining in value, compared to the liabilities you owe, or in other words, the depositors, that's when a bank can become insolvent. And if the market gets nervous about that, if depositors get nervous, that's how you get these runs when everybody wants to pull out at the same time because they're concerned there might not be enough on this side of the balance sheet to make the depositor side whole. Now, this is super interesting to me because I think we generally think about bank runs as something reserved for history, but here we are experiencing one in real time in 2023. What's going to also be interesting is whether or not this is an isolated incident or if more banks across the U.S. are exposed to this same type of risk. And my hunch is there probably are some other exposed banks, because we're seeing such a movement in cash. You know, guys like me have been telling consumers you can earn a way better rate of return on your savings by shifting it to either other banks or even buying things like U.S. Treasuries. Again, I showed that previous chart. Government bonds today, the short-term government bonds are yielding 5%. And I know a lot of the biggest banks in the U.S., I mean, especially on their checking accounts, are paying virtually nothing. So this could be a bigger problem, and that's what the market's trying to digest. And we're seeing that in the decline in share prices across banks broadly. So anyway, I thought this was a topic that people might find interesting, kind of help folks understand what's going on. Obviously, if it was good or helped you out, do me a favor, just give me a thumbs up. Lets me know you enjoyed the video, and I hope we will see you on the next one.